Hello, today I am going to talk about in the AS-12, that's about income taxes. The objective of this standard is to prescribe the accounting treatment for income taxes. The relevant accounting standards relating to income taxes are in AS-12, IAS-12 and AS-22. There is no major difference between Ind AS-12 and IAS-12. So what is the significance of the standard? Of course you may think. So the differences between the profit as per financial statement and profit calculated as per income tax laws as one of the main reasons to introduce this standard. Okay, so why this difference is happening? The first reason is the accrual basis followed for calculating the income, whereas tax laws does not follow the accrual system of accounting for all expenses and revenue. So what is the accrual system of accounting? It's a system of accounting in which transactions are entered in the books of accounts when they become due date, that is earned date. Okay, so as per accrual concept, it should be recorded when income is earned. When income earned, record at that time. Okay, actually earning date and receiving date will be different. For example, we can take employee salary that were earned in month end. Earned date means due date. Okay, however, salary received on next month. For example, January 31st may be the due date of salary, that is the earned date, but received date may be on February 1st, 2nd, maybe 3rd. So this is the first reason for differences between the profit as per financial statement and profit calculated as income tax laws. Second reason, tax laws allows more depreciation than the accounting principle. And third one, provision for expenses is accounted on accrual basis in accounting, whereas in tax, these expenses are allowed only on cash basis by the tax authority. So these are the reasons for the differences between profit as per financial statements and profit calculated as per income tax laws. Okay, so the standard gives the answer to how can we adjust those differences. Okay, then the objective of this standard is to prescribe the accounting treatment for income tax. And then scope. The standard must be applied to accounting for all income taxes, including domestic, foreign and withholding taxes, as well as the income tax consequences of dividend payments. And this Ind AS-12 does not apply to, first one, accounting for government grants, secondly, investment tax credits. However, Ind AS-12 does apply to accounting for temporary differences that may arise from such grants or investment tax credits that we will discuss later. Okay, now let's have a look at some definitions which is important for the standard. First one, accounting profit. Accounting profit is the net profit or loss for a period before deducting tax expense. Accounting profit is a company's total earnings calculated according to GAAP, that is generally accepted accounting principles. Next concept, taxable profit. Okay, this is the profit for a period determined in accordance with the rules established by the taxation authorities based on which income taxes are payable. That is, taxable profit refers to the profit of the business which is taxable as per income tax rules. Next concept is tax expense. Tax expense for a period is the total of current tax and deferred tax. Here current tax means the amount of income tax payable which is calculated on the basis of the provisions of the Income Tax Act 1961. Okay, deferred tax I will explain you later. I will come to that point. Okay, then fourth concept, fourth definition, current tax. Okay, that's I already discussed. That is, current tax is the amount of income taxes payable on the taxable profit for a period. Okay, let's take this example. Mr. X purchased a machinery of ₹500. Its useful life, that is economic life, is 2 years. Depreciation charged SLM method. No salvage value. Okay, and the tax rate is 30%. Profit of Mr. X before charging depreciation, first year 2500, second year 2500. Okay, let's see its accounting. Here in this problem, one more thing that's important to note, that is here, as per income tax or government says, first year 75% you have to charge as depreciation. That is 75% of the cost of machinery we have to charge as depreciation. Okay, and 25% next year, that is 25% second year. First we need to prepare balance sheet as per books of accounts. Okay, first year balance sheet said machinery cost is 500. We have to deduct depreciation. First year, how much we deduct? 2 years economic life, its cost is 500. So first year 250 we will charge depreciation. So written down value 250. Okay, then profit before depreciation, how much? It's given in the question, 2500, and we have to deduct that year depreciation, that is 250. So 2500 minus 250, profit is 2250. Okay, so accounting profit is 2250. Okay, and if the tax expense is 30%, it's given in the question, tax rate is 30%, we have to apply this 30% on this accounting profit. It is accounting profit, how much? 2250. Okay, so 2250 into 30%, that is 675. Next we need to calculate taxable income. Okay, taxable income means that is the profit as per Income Tax Act, that is the government calculation. Okay, here also cost of machinery is rupees 500 and depreciation we have to charge 75%, that's given in the question. Okay, 75% of the cost of machinery we have to charge as depreciation in the first year. Okay, as per Income Tax Act, so we need to calculate 75% of 500, that is 500 into 75%, that will be 375. So depreciation, first year we need to charge depreciation 375. Okay, so depreciation is 375, so 500 minus 375, written down value will be 125. Okay, so here profit before depreciation same 2500, right? So we have to deduct this depreciation, what we get, 375. Okay, 2500 minus 375, that is 2125. Okay, this is taxable income. Okay, so on this taxable income we need to apply tax rate, so that will be our current tax. Okay, so current tax is equal to 2125 into 30%, that is 637. Okay, current tax is 637. So this is our actual tax liability. We need to pay rupees 637 to government. See here, our tax expense as per accounting profit was rupees 675, right? But as per Income Tax Act, our tax liability is how much? It is rupees 637. There is a difference of rupees 38. Okay, there is a difference of rupees 38. So the difference of rupees 38 which got created in the first year will get reversed in the second year. This is temporary difference, that is reversible difference. It's called timing difference. Okay, so timing difference starts in one period and the difference will automatically get adjusted in the subsequent accounting periods. If it gets adjusted, it's called timing difference. If it doesn't get adjusted ever, we call it as permanent difference. Okay. Please note one important observation here that I want everyone needs to focus on. That is, in whatever we discussed now, depreciation is the point which we change the calculation between accounting and taxation. That is, as per accounting norms, depreciation was different. As per taxation, depreciation was different. Okay. Depreciation is timing difference. That is, difference created in year 1 is getting reversed in year 2. Hope you clear with this concept. That is, timing difference, it's temporary in nature. That is, difference will get reversed in a matter of time. And permanent difference is permanent in nature. Difference will never get reversed. Okay, let's continue with this example so you will be clear with this concept. Okay. If you look at the tax implication, year first, depreciation as per accounting based calculation, say rupees 250. and depreciation as per Income Tax Act, it's rupees 375. In year first, we had 675 rupees as tax expense and 637 rupees as current tax. Now let's check what's happening in second year, okay? And we are doing second year balance sheet as per books of accounts, okay? Here machinery it is 250, cost 250, okay? Depreciation second year 250, so nil, okay? Here profit before depreciation, it's 2500, right? And we have to deduct depreciation second year 250, then profit will be 2250. So here second year also accounting profit would be 2250, and you have to apply 30% on this 2250. So the tax expense will be second year also 675. But at the same time, we have to calculate a second year profit calculation as per Income Tax Act, that is government calculation, okay? See here, machinery cost is rupees 125, right? That is first year written down value was 125, okay? You can check the first year calculation, it's 125, okay? Then we have to deduct depreciation, that is how much we have to deduct. Problem says it's 25% we have to charge depreciation, that is 500 into 25%, it's exactly 125. So deduct 125, that is 125 minus 125, it's nil, okay? So here profit, second year profit also 2500, and you have to deduct depreciation 125, and how much the amount would be 2375, okay? So taxable profit here 2375, okay? So the current tax is 2375 into 30%, that is 713. That is our current tax, that's our actual tax liability. So note one point. What was our tax expense second year? It was rupees 675, right? That was our tax expense. That is the tax liability calculation based on accounting profit, okay? And then what was our current tax? Current tax means our tax liability calculation based on Income Tax Act or government calculation. It was rupees 713. There is a difference between these two, that is 713 and 675, that is rupees 38. Okay, I will draw a table so you will get a clear picture about tax expense and current tax for the first and second year, okay? So this is the table. So first year, second year, tax expense. See, first year tax expense was rupees 675 and second year also 675. And current tax, see, first year 637 and second year 713. First year our tax liability, so our actual tax liability is current tax, right? That is this is the calculation as per income tax law. We have to pay rupees 637, okay? That means even though 675 accrued to the company as tax expense, that means company is liable to pay that, but only 637 was due in first year, okay? The balance is not due, okay? The balance actually due in the second year. So this 675 is finally being paid at some point of time. Out of 675 rupees, which is recognized as tax expense in the first year, only 637 paid in first year, okay? Balance 38 paid later. We deferred it, we postponed it, okay? Then we come to the second year. What's happening? See, second year current tax is rupees 713, okay? Second year our tax expenses 675, but we have to pay 713, that is 38 extra you need to pay. That is the crux of this accounting standard, is that in the second year current tax liability increased by rupees 38 as per Income Tax Act, whereas deferred tax liability of rupees 38 created in the first year is reversed. Okay, that is first year rupees 38 is deferred tax liability. We are creating a deferred tax liability that we need to pay later. We need to pay it in future. And in the second year, this deferred tax liability which we created in the first year, that is rupees 38, it's reversed. It's reversed in the second year. Okay. This is the crux of this accounting standard. Okay, in this video I try to explain all the major concepts like accounting profit, taxable profit, tax expense and current tax, and what is deferred tax liability. And if you understood what is deferred liability, you can understand what will be deferred asset and what is temporary difference or timing difference. All these concepts are the major areas in this standard. So I hope you understood all these concepts. Okay, so thank you for watching. See you in the next video.